You monstro. Yes. All right, you filming? Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our weekly commentary on market events. And now, let me start. I don't know what to say about the dog.
I think of something fast.
I know, because he's about to take off. Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our weekly commentary on market events. He whined. We got to do it again. You can't whine.
He's going to whine harder the longer this takes.
I know. What?
I'm keeping all of this in.
No, you're not. All right, we got to let him go. He's not. He keeps. I'm not your show pony. Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our weekly commentary on financial markets. Let's get started. This week, financial markets have been shaken by a series of inflation readings that have been much higher than market analysts expected. This has set off fears that maybe rising inflation, it's been much talked about, it's been much predicted, maybe rising inflation is going to derail this bull market. Importantly, at least for the time being, it certainly has taken a lot of froth off the market, with some of the largest declines in the S&P 500 and Dow Jones that we've seen thus far in 2021. So, what do we think about these increases in inflation? Do we believe this could be the beginning of the end of the bull market that we have enjoyed for the last year? So, first of all, let's divide this into two questions. The first question is could this be the beginning of an inflationary surge? And then second, could this be the beginning of the end of the bull market? Our answer to that first question is maybe, but we're not quite sure yet. The evidence will have to compile. Our answer to the second, could this be the beginning of the end of the bull market, is we don't think so. Even if this is the beginning of an inflationary surge, we think that the bull market still has at least another year to run. And we'll explain why here in a second. So, in terms of the inflation, could this be the beginning of an inflationary surge? Well, we have been worried about and writing about the potential inflation implications of Fed policy since September of 2019, before COVID, when the Federal Reserve started printing money and buying government bonds to help bail out the Trump administration from their big deficits. The bond market had collapsed in September of 2019. There was real risk that interest rates were going to rise, and the Fed, even though unemployment was only 3.5%, even though we were not in any kind of economic crisis, they took out their most powerful weapon. They started printing money and buying government bonds in September of 2019, when there was no real crisis in sight. Now, we did not know that a few months later there would be a real crisis. But in September of 2019, we started saying, wow, this is new. Well, it's not completely new. This is exactly what the Fed did in the 1940s that led to inflation. This is exactly what the Fed did in the 1970s that led to inflation. So this is new for our professional lifetime because we thought the Fed had learned this lesson. Right? Now, fast forward a few months from September 2019, and we had a real honest-to-goodness crisis. And as we had feared, if they're going to print money and buy bonds when you don't have a crisis, when unemployment is 3.5% and economic growth looks fine, then when you have a real crisis, they're going to print more money than you can imagine. And sure enough, the money printing accelerated to more than $5 trillion. And we have been worried that the ultimate consequence of all this money printing could be inflation. So are those worries coming to fruition? Is that moment now? Well, we need to recognize that there are two things that are temporarily increasing inflation. The first is we're comparing current prices to the prices from last April. And that was the height of the pandemic and the lockdown when we had a big collapse in prices across the economy. So you're comparing the lows of last year to current prices, and of course that's going to inflate the numbers. The other thing that's happening right now is we have a temporary series of shortages. One of the biggest is in microchips, which means that we're pretty much so not making very many cars and trucks. And that means that used car and truck prices are up 10-15% because we're simply not making any new ones. And rental car prices are absolutely, hundreds of percentage point increases because when no one was traveling, the rental car companies sold off their fleets. They've got to buy new cars to replace them. New cars aren't being made. So to rent one of the cars that they do have available, be prepared to pay through the nose. And those huge price increases are reflected in the inflationary numbers. Now, those are temporary. As you get the production of microchips up, you get cars. Now that the pipeline is running again, gas prices will probably start moderating again. So there's some temporary things that could mean this is just exactly what the Fed is hoping it is, which is a temporary spike in inflation. But I have to acknowledge, since I've been worried about this for more than a year, am I worried that this really is the beginning of inflation? Absolutely. Because I think the Fed started printing money when they didn't need to, and then they printed a huge amount of money, and now I'm worried that the federal government is addicted to that printed money and the Fed won't be able to stop. So, why don't I think that this could be the beginning of the end of the bull market? Well, because as we showed in our strategic insights that we published at the end of last month, there is virtually zero connection between inflation and market returns over the next year. Inflation doesn't end bull markets. What ends bull markets is when the Federal Reserve decides that inflation is a problem and they start raising interest rates, shutting off their printing presses. That has two implications for equity markets. Interest rates go up, that's not good for equity prices. And when they shut down the printing presses and start sucking money out of the financial markets, there's less buying power to keep pushing markets higher. So there's a 1-2 punch when the Fed decides that inflation is a problem and they've got to start fighting that inflation. And we do not think the Fed is in any way ready to start fighting inflation. For one thing, because they've told us they're not ready to start fighting inflation. Fed Chairman Powell has made it crystal clear. Hey, inflation's going to be popping up here for a little while. We think it's completely temporary. We're not going to worry about it. The second thing Powell's done is he's changed Fed policy. For most of my professional career, whenever inflation went above 2%, you could count on the Fed to tighten monetary policy. Well, Powell changed that policy. He said, we're not going to target 2% inflation. We're going to target an average inflation rate of 2%. What's the difference? Well, for most of the last 10 years, inflation has been below 2. So if the Fed is now targeting an average inflation of 2, they can let inflation go above 2% and stay there for years before the average inflation rate gets to 2. So both because the Fed chairman made it clear he thinks this is a temporary spike in inflation, and because the Fed chairman has said he's not targeting 2% per se, he's targeting an average of 2%, and since we've been below 2 for a while, it needs to be above 2 for a while. For both of those reasons, we just don't see the Federal Reserve getting serious about fighting inflation. And until they get serious about fighting inflation, we don't think the bull market comes to an end. Let's put out one more reason why we think this bull market isn't going to come to an end, is that there's a conflict ever since September of 2019, when the Fed started printing money to help the government fund big deficits. From that moment on, there became a conflict between the Fed's desire to help the government keep funding itself and keep interest rates at a level that's comfortable for the general economy, and the Fed's mandate to fight inflation. Those two things are in opposition now. And the deficit's still huge. The Biden administration wants to do a huge infrastructure program that's going to require even bigger deficits. And that pressure on the Fed to keep printing money and buying bonds and helping the government fund these big deficits, that's going to stay. And it may even get more intense. And that means that the Fed, because there's a conflict between their desire to keep the government funded and their desire to fight inflation, that says to us that if they've got a mistake to make, they're going to make a mistake of giving the economy more rope, of keeping interest rates lower for longer, of keeping the printing presses running longer than they would have otherwise, because right now they're more focused about helping fund this giant debt load than they are focused on fighting inflation. What does that mean for the short-term equity markets? It means really, really good things. And that means that this week's panic selling is kind of like the panic buying of gasoline. It'll look kind of silly in a week or two. Thanks for joining us for Market Insights. We hope you found it informative. If you did, please like the video and share it with your friends. Also, you can find our other research on our website, caravelconcepts.com. Thanks.